What's going on, everybody? It's Stas here. Welcome back to another video. So I wanted to hop on here on this lovely Saturday afternoon and talk about how to prepare for a stock market sell-off. And ideally, I'll preface it with this. Ideally, it's great to always be prepared. But if you're finding yourself scrambling right now that the market is selling off, this is a way that you can get sort of prepared. Although, again, it's always great to be prepared before the drop. But this is a way that you can prepare yourself and just get in the right mental headspace, right? So hit the like button, subscribe, make sure to go down below, get yourself 2 stocks from WeBull and $30 from M1 Finance, and check out the Patreon if you guys want to. All of those are linked down below. And if you guys have not been seeing the markets, the S&P 500 is by no means crashing. I don't want to make it seem like the end of the world is here, because based on this 4-hour chart, via the SPY, which is an ETF that tracks the S&P. A lot of people call it the SPY, right? The SPY ETF here, again, also known as SPY, it's gone down from 395, arguably a very overinflated, overheated spot, right? And we talked about that on the YouTube channel before this drop. And if you guys have been following me for a couple weeks, you know that I've been saying the markets needed this pull down. And we saw the pull down from 395 all the way to where we are right now, hovering over $380, right around the support of this channel. And that's a huge reason as to why it's not the end of the world yet, at least technically speaking, because we're not seeing a crazy crash. In fact, we are still holding the uptrend on this 4-hour chart at a higher low as of now. Things could change, but as of now, 380's holding, right? That is a higher low based on this uptrending channel that we see on this 4-hour chart. And I mean, listen, guys, a correction is anything above 10%. It's anything above 20% is a bear market. So we're down about 5%, not even 4%, more like 4.3%. So we're nowhere near a correction or even close to a bear market quite yet. So I guess you could start and still be prepared for this sell-off if it gets worse, because we're not that deep into the sell-off yet. And even if this rebounds and goes to all-time highs again, which very well could happen, especially if the Fed gets in, calms down this 10-year bond that's been spiking up. You know, if that gets settled down a little bit, who knows what the Fed is going to do here. We could see a rip back up, all-time highs. And even if that happens, guys, this video is still very valid, because you got to prepare, because a big sell-off is coming. A 20%, 30% sell-off is coming. I mean, guys, we just had one back in March about a year ago, and I guarantee most of you were not prepared for that. And we're going to talk about this right now, what I'm doing very quickly. This is more of an informal video, guys, honestly, and I don't have many notes, so it's a little bit off the top of the head, top of the dome, as they say, and I like those videos. So let's just talk. I mean, we saw the S&P not crashing yet, still holding the uptrend, and what I'm doing here, number one thing, is I'm focusing on my foundation, and I'm focusing on my core holdings. A lot of people have the stock market misconstrued, right? They have things twisted. They feel like they just jump in as a beginner and they just start trading all these crazy penny stocks and these high-flying stocks that Kathy Wood's buying or any of these YouTubers are buying. They have it backwards. The truth is, when you're getting into the market, you must focus on your foundation and build a foundation first, and then you can do the more speculative activities, you know, the trading, the options, the penny stocks, the high-flying growth stocks. You can do that around your foundation. So I would heavily focus on this foundation, right? And it depends on your style. I mean, not everyone's foundation is going to be the same. Some people might like, mid caps as their foundation, or large caps, or the blue chip dividends, or maybe the higher growth stocks that are still pretty foundational. And I personally have a good mix of that, although a lot of my foundational holdings, my core holdings, are larger cap. They're not really too risky, although there is inherent risk in everything in life, and especially in the stock market, but they're not that risky in my personal opinion. And when I focus on core holdings, it has to be a company that I can see here and operating for many years to come. I'm talking decades, 10, 20, 30 years. That is what I view as a core holding, and the brand name must be there. Has to be a very strong brand name. And that is what I focus on, right? And again, it could be different for everybody. And some of my core holdings, you may be asking yourself, Stas, what are your core holdings? These are some of them. And mind you, before we get into it, I don't think having 30, 40, 50 core holdings is a good idea. I think having a healthy range of maybe even 5. 5's good. 10's good, 15's good, maybe 20 plus is pushing it a little bit, but I think having anywhere from 5 to 10 to 15 core holdings is the best way to go for my personal experience. And I have Google. That's one of my main core holdings, foundational holdings. I love YouTube. Obviously, you're watching this on YouTube. Google, those are the two biggest search engines. So Google must own, at least in my opinion, for my personal portfolio. It's a foundational holding. Disney, also foundational. This brand, I mean, it lives through lifetimes. And by that, I mean, when the next generation comes, it lives through them, their kids, it lives through them, and things could change 100, 200 years out, maybe, if the tradition, the Disney brand doesn't last, but at least for my generation, my kids' generation, although I don't have kids yet, but I'm sure they're going to be watching Disney by the looks of it, and looking at little kids these days with all the Disney movies, guys, the parks, the magical, just the magic that Disney brings to kids especially, and even adults, guys. I was in Disney last year, and I'm in my mid-20s, and I loved it. It was awesome. It was like a blast from the past because I grew up on Disney. So Disney is a great core holding. Johnson & Johnson, for me, is great. I love it. It's like a healthcare ETF. They do so much. The dividend is solid. The company has been just performing for decades on decades on decades, and I think that is going to last. Same with MasterCard. This is a company that, with Visa, those two payment processors, I mean, who else is going to come into that well-established game and, into those well-established companies in a game that's so hard? I mean, you guys have to understand, building a business like MasterCard, they're available in so many countries, so many different it's different currencies, like everything, guys. It's the way that this is a worldwide operation. Coming in and competing there is very hard. So I don't see many other businesses coming for MasterCard or Visa for that matter. And that's another thing you have to understand with your core holdings. These have to have a very strong moat. A moat is the way Buffett, I believe this is a Buffett analogy where he was like, okay, your business is a castle, and the way that you protect this castle is your moat, for example, or I might be butchering that. How hard is it to penetrate this business? And I think Disney, very hard to replicate. Google, very hard to replicate. J&J, pretty much impossible to replicate. Pepsi, which is the next one, those brands, guys, I mean, there's a lot of food and beverage brands coming about, but Pepsi's still sticking out. MasterCard, no one's going to come and, never say never, but you guys get the point. These are very hard businesses to duplicate, to compete with. PayPal, very similar. And Amazon, the king of businesses that is very hard to compete with. Very hard to compete with. Same-day shipping, the customer service. I mean, gosh, guys, we can go on and talk about that for days. So the way that you could prepare, the main thing I wanted to focus on today was really just the foundation, have that core, and build around that. And for me, guys, the way I view foundational holdings is I'm not really looking to sell them. I'm looking to just buy more of them on the dips and hold and reap the reward of the dividend if they pay dividend. Not all of those. And by the way, guys, those are not all my foundational holdings. There's a lot more, a couple more, not a lot more, but those are a couple of them, most of them. And the way I view it is, again, I reap the reward of holding the stock by getting the dividend from companies like MasterCard, J&J. Disney used to pay, not anymore, but they will reinstate that later on. I'm not worried about that. Pepsi pays a dividend, and Google, Amazon, PayPal, they don't. But it doesn't matter because I want these companies in my portfolio, and I think they're here to stay for a very long time. And I'm just adding on to them or into them on these dips until there is maybe a change of pace in the different markets they operate in. I mean, if let's say a new search engine comes along in 20 years, then I'd sell Google if there's a serious threat there. Or if the business like Amazon, let's say Amazon's not Amazon anymore in a couple of years, then I'd sell. So the idea here is I'm not touching or selling my core holdings. I'm only adding to them unless something ridiculously severe happens to where their business is suffering and in a position where it's not going to be what it used to be. In that case, I would sell out, lock my profits, and then go into a different position. And another thing you could do to prepare for a sell-off, and it's very important to do this as well, is to have a shopping list. And I'm not going to talk too much about this in this video because a couple days ago, and I'll link that video down below, a couple days ago, I made a video going over a bunch of stocks that I'm looking to buy during this next sell-off. I'll link that down below, but the gist of it is have a sell-off watch list, a market drop watch list, whatever you want to call it, to where, okay, if the market drops 10, 20%, it drags down these stocks as well. You're going to be able to add those into your portfolio at cheaper valuations. I mean, a lot of people, they get scared when the market drops, but if you have a plan, you know what stocks you want to own, you've done the due diligence, the research, you're just waiting for the price to go down. When the market drops, you're like a kid on Christmas. You're very excited because the price has gone down for an asset that you know has great value for years to come. So that should make you excited. And that, if you have that watch list, that shopping list, that allows you to go and buy those stocks. And on top of having that watch list, the shopping list, you should know what price you want to buy these stocks at. So let's say, for example, quickly, if I wanted to buy Square, you should know, okay, I'm looking to buy Square at 130. If it gets to 130, I'm buying half of my goal position. If it gets to 100, I'm buying the next half. You guys get what I mean? Understand where you want to end up buying these shares. And again, I'll link that video down below if you want to see more in depth what stocks I'm looking to buy during this next sell-off. And the third thing you should do is have reserves. And by that, I mean have cash reserves, 15, 20% of your portfolio, 30%. It really depends on you, honestly. There's not a set in stone rule for that. And I've talked about this so much that I don't want to go too far in depth with it. But if you have cash, you're pretty much in a very good spot when the markets drop, because going back to that shopping list, you're able to buy stocks at a cheaper price, right? You could also have gold reserves if you want a hedge against inflation in case the markets drop, hedge against the markets to the dollar even, so that could count as reserves. And even something like Bitcoin, Bitcoin, although it's very volatile, it's a little speculative still, in my opinion, this is something that you can have instead of cash. So these are all reserves that, in my opinion, are a good way to, prepare for a market sell-off. So yeah, I'm running out of breath, guys. Let me know down below in the comments. What are you doing? As always, I would love to know. Hit the like button. Make sure to subscribe to the channel. And don't forget to get some free money. You get 2 stocks down below from WeBull. Those are valued up to $1,600. And you can still get $30 from M1 Finance, right? I'm forgetting the deals, guys. $30 from M1 Finance. That's also linked down below. And you could check out my Patreon if you want to support me and the channel a bit further, get real-time buy and sell alerts, real-time call-outs, access to me throughout the trading day via DM, and a bunch of exclusive content every day for the top patrons. I'm actually doing a video Monday through Friday, or whenever the trading days or whenever the market's open, I'm doing a video. So yeah, check out that Patreon. Also linked down below. I'll catch you all in the next video. Thanks for watching as always. Peace out, guys.